Hi everyone, this is Narender Reddy. I welcome you to the new season of Know Your 4C Fund Manager. And today we will be exploring the world of fixed income markets. Last 3 years have been characterized by significant market volatility. We have had COVID related shocks, then Russia Ukraine war, then inflation spiked up, and now there are fears of recession. Given this volatile backdrop, we now have an expert speaker who had spent more than 2 decades in the fixed income markets. He's passed out from the prestigious IIM Calcutta and then worked with institutions like Deutsche Bank, HSBC, and has been heading the fixed income for IDFC asset management for more than a decade now. Welcome to the show, Suyash.
Thank you so much. Pleasure to be here.
Suyash, I would start the show by asking you your views around global macros to start with, and then we can build on how investors need to kind of strategize on their portfolio management. So, what are your views on the way central banks responded to COVID? First, they have kind of turned extremely loose in their policy stance, and then we have seen inflation spike up, and then they've swung on to the other side of the pendulum, where they have kind of significantly tightened like we have never seen before. So, what are your views?
So, obviously, developed market central banks did not anticipate this strong and sustained rise in inflation that we have seen over the last, let's say, a year or so. Partly it's understandable because the context prior to COVID, if you remember, was, if anything, them trying to desperately generate inflation at target levels and falling short almost sustainably. So, Japan was sustainably facing a shortfall in inflation. The Eurozone seemed to be getting there. And the Fed was actively pursuing policies like average inflation targeting in order to anchor inflation expectations around 2% and not lower. So the entire mind frame was to actually expect a lower than target inflation rather than higher, and therefore this transitory narrative probably stayed too long. Because probably what they did not anticipate is the effect of the massive fiscal transfers that governments undertook as a response to the COVID. However, and the volatility in their reaction function notwithstanding, one of the important takeaways is that markets pretty much have not lost confidence in the central bank's ability to manage inflation. This is most clearly denoted in inflation expectations that trade in developed markets. And for example, if you look at the US, the long-term inflation expectations are not significantly higher than what has been previous averages. So what you have to compliment them for is that once they realized their mistake, they were very credible in the pace of hiking that in fact they implemented last year. And probably they are now getting to a place where they are getting more comfortable that most of what needed to be done has been done. And in return, markets or fixed income markets have tended to now turn less volatile as market participant expectations and central bank expectations on where peak rates are going to be are now beginning to converge. So all in all, yes, it could have been handled differently with the benefit of hindsight, but the important thing is that it's not as if credibility has been lost, which is what inflation expectations are signifying.
Sure. And for the first time, you have seen the Fed chairman kind of acknowledge that inflation is kind of coming under control, and that kind of signals that we could possibly head towards the end of the rate hike cycle. Where do you think the terminal rate would be?
So, like you said, it's pretty much a workable hypothesis that we are within shouting distance of terminal in most markets. Right, Eurozone being one exception where the hawkishness started recently, and therefore probably the ECB thinks that they have slightly more ground to cover. But if you look at US, you look at Australia, look at New Zealand, you look at a lot of these developed markets, we are pretty much in sight of terminal. So in developing markets like India, but that we'll discuss separately. The important thing now is, where exactly that terminal lies. But even more important is how long they spend at that rate before they start to cut. So, especially after, spate of stronger than expected data recently, the peak rate, as far as the Fed and markets are concerned, are pretty much aligned at roughly around 510, 515 in the US. The market still think that the Fed will probably start to cut by end of 2023.
Sure.
The Fed still disagrees with markets on this, and this is one reconciliation that is pending for global markets through this calendar year.
Sure. While rates could be one kind of data point to kind of track, but more importantly, we have seen for the first time that there is kind of YOY decline in the money supply, and it's easy for the markets to digest quantitative easing, but tightening is something that markets will kind of will find it difficult to fathom. What are your views on that?
So that's actually a very, very important point, because I'm not even sure that it's, one can model with any amount of accuracy the combined effect of all this tightening that has happened that will hit economic growth with a lag.
Yeah.
So what is notable is this is probably one of the fastest pace of monetary policy rate increases that we have seen in recent working memory. So we have seen higher levels of rates, but going from 0 to close to 5% in a matter of little more than 1 year, accompanied with going completely, so to speak, cold turkey on balance sheet expansion and then starting to withdraw liquidity. So like you observed, monetary aggregates in the US on a year-on-year basis have turned negative, and you still have this close to 500 basis point of cumulative tightening. Now, as we know, monetary policy impacts economic growth with roughly a 3 to 4 quarter lag.
Right.
So what has been done
Sure.
is not getting reflected in concurrent data.
Sure.
And therefore, part of market narrative for 2023, which is basis concurrent data, may then need to get revised as the cumulative impact of all this tightening starts to show into economic growth, which probably happens over H2 of 2023.
Sure.
So this is something that, as of now, one cannot take too sanguinely, although the year has started off with optimism on economic growth. But, like I said, probably most of this cumulative tightening is yet to show in economic growth, because that sufficient lag needs to happen before it's visible in data.
So are you suggesting that there's going to be growth slowdown and growth shocks going forward?
I wouldn't characterize this as a shock yet, but it is very much part of our base case hypothesis that X of China, the rest of the world is going to continue to slow this year, which holds true for India as well. So, for example, currently, there is still relative policy optimism that we will grow in the vicinity of 6 to 6.5% on real GDP terms for the financial year ahead. We think India will outperform most of the rest of the world because domestic drivers for growth have finally kicked in quite strongly. But at the same time, as the world or most of the world slows, we think India will also have to reflect that primarily through the external channel. And therefore, our sense would be that probably for the next financial year, India grows in real GDP terms somewhere around the 5.5% area. Right? So we are building growth slowdown in most of the world X of China. And which is why I said probably concurrent data is a poor indicator given the accumulated impact of monetary tightening that is yet to be felt. In India to a lesser degree, but probably in the Western world to a slightly greater degree.
In fact, one should also acknowledge that Indian policy response was far more measured.
Absolutely.
And that had kind of led to some kind of the overall shock that India had taken and the kind of resilience that India has shown in the last 1 year, especially due to commodity price spike and then also due to hawkish kind of tightening by the developed market central banks. I think India has come out really, really well. I mean, what's your view? I mean, going forward, it is going to be more resilient?
So absolutely, a central premise of ours last year was, if you recall, for most of the year, market was worried about rate differential between India and US, right? Now, our view through this was that you have to look at this 2.5 year period as one block of time. And precisely the point that the cumulative fiscal and monetary response in India was much more measured. And therefore, the overhang that you had to clean up was almost, negligible. Whereas in the US, something like 20% of their GDP was administered as fiscal expansion. A significant portion of that was direct cash transfers to consumers. the Fed doubled their balance sheet and cut rates to zero. So the scale of monetary and fiscal easing was very, very different, and therefore the cleanup of overhang they had to do was therefore that much larger. Now you see how markets' expectations have evolved. So I'll give you one example there. So around May, June of last year, there was a view in India that, policy rates in India will peak somewhere around 7.
Yeah.
At that juncture, the peak policy rate expectations in the US was somewhere around 3.5 to 4%.
Yeah.
Now the peak policy rate in expectation in the US is 5 to 5.25,
Yeah.
and most of the market is comfortable with India peaking at 6.5 to 6.75.
Yeah.
Right. So you see that in markets' mind as well, we are now happy to live with lower rate differential, because this implicit, the way India responded to the whole crisis, and therefore, the lack of over stimulus, etc., is now being appreciated by markets as well. And that is one of the clear strengths, like you alluded to, for the year ahead.
Yeah.
That, like I said, there is not too much of an overhang that you need to still work through.
Sure.
Which is very unlike, for example, what's happening in US and Europe.
Yeah. And also, I mean, you alluded to kind of the shortened of the curve. There's hardly any spread that's there now. Even at the long end, the spread has kind of converged to kind of historical lows now. What would this mean for the foreign flows to Indian markets, especially bond markets?
So look, over the last 3-4 years, bond flows into India have actually already been quite muted.
Right.
So the bond market here does not think about external flow supporting bond demand, truthfully speaking, unless a push factor like index inclusion, etc., was done, which is clearly not on the government's agenda for now. But one way to also look at rate differential is that US is experiencing much higher inflation than normal, whereas India is experiencing probably at this juncture 100 basis point higher than normal.
Yeah.
Right. So from that standpoint, the amount of work that the US needs to do to bring inflation back to trend logically has to be higher than what India has to do. Also, on the rate differential theory, the channels through which capital flows happen when rate differentials are large are not as clear.
Yeah.
Right. So we do think that over a period of time, rate differentials will widen again, as the US, when inflation gets controlled, will have more room to cut, whereas India may have lesser room to cut. But at peak of this cycle, we are comfortable with the idea that policy rate differentials will not be more than 125 to 150 basis points.
Essentially, the rate cuts that RBI would have to do would be substantially lower than what Fed might kind of resort to, if not towards the end of 23, maybe in 24, you would see more aggressive rate cuts coming in, especially kind of, if not growth shock, the growth slowdown that could kind of come in now with what is kind of going on now.
So the way I would think about that is, there's this concept of long-term neutral nominal rates. Right. So in India, probably the long-term neutral nominal policy rate is somewhere in the vicinity of 5.5%, give or take.
Right.
In the US, and this is a very difficult concept to measure, so it's a very vague, kind of assertion. But in the US, you could argue that it's somewhere in the vicinity of 3%. So once, central banks are pretty much confident that inflation has been gotten a hold of, and they are beginning to get concerned about the momentum on growth, they will probably want to get policy rates back towards neutral, which in the case of the Fed would mean eventually, probably over 24 and 25, you would have room for 200 basis points of rate cuts. In the case of India, it would be much more modest.
Yeah.
But let me caution, basis current view and portfolio strategy, we are basically assuming a long hold at current levels on policy rates.
Both globally and in India.
For practical working purposes today, yes. But we are, kind of cognizant of there are 2-3 pathways that the world economy could take. In one pathway, it is a soft landing scenario, in which case over the next couple of years, probably policy rates go back towards neutralish only. If we get into a hard landing scenario, then it's a separate thing that we need to think about, but that's not part of the base case at all.
Sure. And what could be the drivers of, let's say, if at all there's going to be a hard landing, what are your key risks that you're kind of building in?
So let's take again the developed world.
Sure.
Suppose there is more persistence to inflation, and central banks have to keep rates at, let's say, in the case of the US, 5.25, in the case of Europe, 3.5 for much longer, even when growth is slowing down. So if it so happens that to bring down inflation by 1 unit, the growth sacrifice required is more than what we currently envisage.
Yeah.
then central banks will have no option but to kind of see through the process wherever it takes growth. But again, this is not part of the base case. The base case remains that market has pretty much gotten a good grip of where peak policy rates are going to be. You would potentially have a softish landing. At some juncture, central banks will be in a position to cut. But currently, there is this tension between markets and central banks, where central banks are saying, look, maybe you're wrong, we will have to keep this higher for longer. And markets are saying, no, we think you are wrong. And at some juncture, you'll be cutting. And this tension will get resolved one way or the other over the next 6 to 9 months.
Sure. And while there are these growth-related concerns, but the other bigger risk that world has been seeing is the deglobalization and the kind of geopolitical tensions, not just between Russia and Ukraine, but the kind of commentary that comes from China and US of late, the kind of new developments also. What's your view? I mean, where is the world moving towards, and what would it mean for global growth and, let's say, an economy like India?
So, generally speaking, for the world, before I come to India, this unfortunately does mean that capital is not being deployed where it's most efficiently utilized, but there is a certain degree of certainty that you need on let's say whether you can source raw materials or where you decide to put in production, etc. Which basically means that probably the floor level of average global inflation has now moved higher on average, and trend rate of growth probably is a shade lower than what used to be in the earlier regime, where there was more free flowing allocation of capital across the world. For India, this as gets discussed often, is also partly an opportunity, because we do need kind of more export robustness, because over a longer period of time we need to be able to demonstrate that we can grow at 6% at a current account deficit of 2.5%. Right, so we need to be growing at 6% and a current account deficit of 2.5% of GDP. Only then does the 6% growth rate become sustainable. And for this to happen, you need to capture more export share. And when global value chains, kind of get disrupted and reorganized, that's where your greatest opportunities are. So probably this also counts as an opportunity for India. Not to mention this long period, balance sheet stress that banks and corporates were facing to some degree, which is now behind us, right? So that's another big tailwind that India is probably now experiencing and enjoying.
Possibly this is the first time when we are seeing government's balance sheet at the kind of strength that it has now, the corporate balance sheet and the banking system balance sheet. I think this is the first time in many years, that we are seeing this kind of strength. So what are your views on budget, and has government done enough in terms of taking this China plus one opportunity or Europe plus one opportunity?
So if you see the context of the current financial year, FY23, right? So what you had is very large nominal growth expansion because of high inflation that suddenly kicked in, which in turn gave significant cushions on the revenue side, because tax revenues, etc. also got bumped up because of high nominal growth rate. On the other hand, you got a very massive commodity shock, because of which the government had to step in to increase allocation to food and fertilizer subsidy in order to protect population from the commodity shock. Now for the financial year ahead, which is FY24, nominal growth rate kind of normalizes. So the government is assuming 10.5% growth rate. We think it will probably be between 9.5%, but nominal growth normalizes. So therefore that cushion on revenues is lesser. Correspondingly, the spent on subsidy is reducing by 70 basis points of GDP. Now one option in front of the government would have been that use most of the 70 basis point that is getting reduced out of subsidy to consolidate your fiscal further. Instead, the government has rerouted that into capital spending, which could partly be to address the specific question that you asked, and partly also because probably in an uncertain and slowing world, the government probably thought that it's not a given that private sector capex acceleration continues for the year ahead, and therefore some support to capital spending may have been required from the government balance sheet, which they have provided for. So in some sense it is quite a forward looking budget, taking into account the global uncertainties that are probably ahead of us. The bond market has really liked it because one of the things that bond market worried about is the gross borrowing program is going to turn out to be higher, but at 15.4 lakh crores it was pretty much at the lower end of expectations range. So all in all, from a macro and bond market standpoint, it was a well-liked budget.
Sure. And the kind of your base cases, the nominal GDP growth rate would be somewhere around 9.5 to 10, and the government is kind of tied above around 10.5. So where do you see the gap? I mean, what could be the driver for this gap between your estimate and the government?
So one, we think real growth rate is going to be around 5.5%.
Sure.
So that 100 basis point is actually coming from there.
Yeah.
There is one other downside risk that the deflator itself
Yeah.
could turn out to be slightly more weaker,
Sure.
which is something that we'll have to see as the year progresses. So as of now, we are happy to have a 9.5% kind of working assumption for nominal growth rate,
Sure.
which is roughly 100 to 150 basis point lower than what the government is assuming currently. But
Sure.
bear in mind, there are certain flexibilities built into the budget.
Sure.
Right? So you can always reroute some spending in order to still go ahead and maintain the 5.9% deficit that they have put on the table.
And going back to my question on geopolitical tensions and the resultant spike in commodity prices that could kind of come in. So what are your views? I mean, especially crude could be a spoil sport, especially for market like India.
Yeah.
What's your view there?
Well, one has to hope that it doesn't play as big a spoiled sport as it played last year, right? Because when you are just recovering growth after the COVID shock, you actually need some of these things to be relatively better behaved, especially oil, which India has a large external dependency on. We are hoping that as most of the developed market stimulus fades through demand,
Sure.
even though there is a counterbalance coming from China to some extent, that oil and generally commodities are kind of, even if there is some upward pressure, it's not the kind that you saw after the war broke through between Russia and Ukraine. So, for example, RBI in its estimates, in its projections rather, has oil closer to 100.
Right.
Right. Whereas we are currently in the 82, 83 vicinity.
Yeah.
So there is cushion.
Sure.
And the next $10, $15 we can work through. We are hoping that that's all we have to work through.
Sure.
And the base case for now remains, unless there is a massive new geopolitical shock, which obviously you can't put as part of your base case, just from the way demand evolves, and even accounting for Chinese opening, we are still thinking that commodity generally should be manageable.
Sure. All you're saying is the kind of growth gap between your estimate and government's estimate could possibly come in from the assumption on inflation rather than the growth in itself.
So real GDP also we are around 100 basis point lower.
Lower.
Right. So real GDP we are in the 5.5 area.
And where do you see that gap coming in? I mean, what are the drivers for this?
Largely the external account, then filtering into domestic demand. So, so if your export sector is slowing down, it eventually with a lag feeds into consumption investment locally as well. And don't forget, even though RBI rate hikes have been more modest as compared to the Fed, it's still significant.
Yeah.
Right. So your effective overnight rate used to be 3.35%.
Yeah.
It is now in the mid sixes.
Yeah.
Right, early to mid sixes.
Yeah.
So there is a close to 300 basis point movement that has happened in India as well.
Yeah.
RBI's own balance sheet has shrunk quite substantially.
Yeah.
We are projecting core system liquidity, unless RBI shores it up, to actually head towards neutral in the next 3 to 4 months.
Sure.
So even India's financial conditions generally have tightened significantly, which also will show with a lag in India's growth.
Right.
So both the global slowdown as well as India's policy response, which will, and it's a justifiable policy response because growth had to slow in order to bring inflation down. Right. So we think we are fairly comfortable with our 5.5% kind of expectation for FY24. And which is not a bad thing at all, because in a slowing world, if you're still growing at 6.5%, there are some imbalances that get built, which probably are not sustainable.
Sure. And India will continue to remain the fastest growing economy.
Absolutely. You will still have relative growth advantages.
Sure. Sure. And coming back to the budget and the net market borrowing also will be around 11-12 lakh crores thereabouts. That would mean there will not be too much of supply side pressure. But one of the important things that one needs to kind of bear in mind is the government is kind of assuming that most of the short-term borrowings will actually come from small savings. So about 1/4 of it. So you think it's achievable, or is government getting too ambitious on this number?
So remember, there are certain initiatives that have been announced in the small savings. So there is a fresh initiative at the 2-year point for women, where the rate seems fairly competitive. If I recall, there are certain relaxations for senior citizens as well.
Sure.
What may also happen over the next financial year is that this aggressive competition from time deposits with the banking sector may not be there to the same extent as growth slows down. So credit growth would also to some extent slow down.
Yeah.
So we as yet don't feel that, that number that they have put for the next financial year is not doable. We think it probably is doable because of the reasons that I mentioned.
Sure.
So as of now, it doesn't look like a budget that you need to be uncomfortable with. With the backdrop globally and the resources available, I think they have done a phenomenal job of balancing macro stability with the growth push.
In fact, I mean, they've done a phenomenal job also in terms of giving the projections in terms of the quality of spending this time around.
That's right.
Yeah.
That's right.
Any views on how this transition that has happened over the last 3-4 years, especially, I mean, where your capex spending has kind of gone almost 2.5 times versus the kind of revenue spend which is going to be increased marginally up. So that kind of would augur well for the growth going forward as well.
Yeah. So one way to look at this is the public sector deficit, which is center plus states plus public sector enterprises outside of their internal resources. Now, broadly speaking, before the pandemic struck, the full year before the pandemic struck, the public sector deficit was running at something like 9.7% of GDP.
Right.
Now, post-pandemic, the government of India had to shoulder the bulk of response to the pandemic, and therefore the government of India, the centre's fiscal deficit expanded. States actually went back to the pre-COVID run rate fairly quickly. So in the FY23, we expect states to print something like 2.4% as fiscal deficit, 2.4% of GDP as fiscal deficit, which is very much their pre-pandemic run rate. Public sector enterprises will probably be at around 1.5% of GDP, which is a good 100 basis point lower than where they were pre the pandemic. So in some sense, it's not so much that aggregate public sector capex as proportion of GDP has gone up. It is just that it has now converged more into the centre's balance sheet, which is also an exercise of transparency that the centre deliberately undertook to take on a lot of capex and show as part of their spending and therefore part of fiscal deficit. So as things stand for the financial year 24, centre does 5.9% deficit. We are assuming states do around 2.6%. And public sector enterprises do a little more than 1%, so that aggregate public sector deficit will still be around 9.7 to 10% of GDP, which is where it was in the year prior to pandemic.
So the glide path, I mean, as we go along, I mean, you would see CPSE capex also could possibly kind of pick up, and states also could participate slightly better. Then next year we could see a better fiscal deficit number.
So look, roughly in the 9.5 to 10% of GDP as public sector deficit, that's pretty much as local savings can finance while running a sustainable current account deficit. So the other thing that we have to watch out for is whenever the private sector capex cycle meaningfully picks up, after this 1 year period of slowdown is behind us, public sector should be able to consolidate more rapidly to allow private sector to lay claim on the limited savings pool that is available. So it's not always the case that higher capex spending by the public sector will always necessarily be a good thing, because you have to also look at it that in context to what the private sector is doing. So for the time being, that's exactly the right medicine. And we do believe, because the centre, remember, in 2 years has to go to 4.5% deficit as per their roadmap. So we do think that it's their intention to allow private sector to lay better claim on domestic savings and them to shrink their total claim there over the next 2 years.
So Suyash, to summarize what you've been saying, that most of the rate hike cycle is kind of towards its end, and at least from an Indian bond market perspective, there are not too many risks that could play out in future, and accordingly one has to kind of build the portfolios.
So let me just summarize that. So last year you had twin shocks to let's say India, both from the commodity spike as well as the one-way rise in the US dollar. Right. and there was huge amount of global bond market volatility as markets and central banks were hunting for where the peak rates are in this cycle.
Yeah.
This year, if you see, bulk of the dollar strength is behind you. In fact, the dollar index peaked in September.
Yeah.
Most large tradable commodities are back to pre-war levels, and global rate volatility, but for stray data points here and there, is beginning to subside.
Sure.
So this is now an investable market in fixed income.
Sure.
And the important point there is that quality fixed income is now probably offering yields which on a reasonable 3-5 year investment horizon is probably going to be inflation beating.
Sure.
Right. So one of the other aspects that investors were worrying about in the post-COVID world was that rates on quality were so low that they were not even beating their assessed inflation expectations.
Sure.
Which may no longer be the case.
Sure. And then one was also kind of looking at the mark-to-market losses.
Absolutely, owing to the bond market volatility. And don't forget the amount of adjustments we have made, right? So at the very front end of the curve, which is, let's say, at the 1 year point, rates have moved up by something like 300 basis points.
Sure.
Right? So a lot of adjustment has been made, which is why the yield curve is now fairly priced.
Sure.
It looks like it's going to be inflation beating.
Sure.
And bond market volatility on the margin is now much lesser than what it was in the last year.
Sure. And no, thanks for that macro update, Suyash. Now coming to IDFC Asset Management's fixed income portfolio strategy or frameworks. So I should compliment you for the kind of reputation that you have built in to have kind of come clean during the credit crisis during 2018 and the kind of volatility that markets have seen in the last 3 years. I think you have kind of come through very clean and the kind of confidence for us as advisors, investors has kind of gone multifold. What differentiates you from the rest and what has been kind of your hallmark of your investment portfolio strategy?
So in all fairness, I can only talk about ourselves.
Sure.
Look, so at a philosophy level, one has to appreciate that a mutual fund is a pass-through vehicle. So fundamentally, your philosophy has to be derived from a simple statement of fact, which is you should largely be buying what you can sell.
Sure.
So obviously there will be parts of your portfolio that you can't sell, but for the most part what you are buying, you should be able to sell because you are a pass-through vehicle. You receive inflow, an investor invests in your fund, you buy assets because of those flows, and that investor takes away money, you should be able to sell the asset and return the money.
Sure.
It's a very simple business model that way, and that in some sense anchors our fixed income philosophy. So the way we think about fixed income funds is, we divide them into a liquidity, core and satellite bucket philosophy. So liquidity is your cash management requirement, so it's your overnight cash fund, etc. The core bucket of products is basically the bulk of fixed income allocation, where we try to take constrained amount of duration and constrained amount of credit risk.
Sure.
And the satellite bucket is where we can take more credit risk or more duration risk depending upon the mandate or the view of the fund manager.
Sure.
By keeping these three buckets, kind of separate, and especially the core and satellite bucket, it also drives our, manufacturing philosophy to say that, in the core bucket, we are self-imposing constrained amount of duration and constrained amount of credit risk. So, the funds in that basically reflect that philosophy. In the satellite bucket, where the positioning very clearly states that we can take higher amount of credit or duration risk.
Sure.
Not that the credit process is diluted, but the amount of risk that you take can potentially be higher. So it's not about quality versus credit in some sense.
Sure.
It is about the bulk of your fixed income portfolio reflecting the fact that fixed income is bought into largely for capital preservation and income generation.
Sure.
And as manufacturer, for the most part, what I buy, I should be able to sell.
Sure.
So actually, these two, from an investor as well as manufacturer's standpoint, very succinctly sums up our fixed income philosophy.
So our 4C framework also looks for this kind of clarity of thought in portfolio management, and which is where IDFC funds kind of pass through all the filters. Given where we are now, so do you think there's scope to kind of increase duration at portfolio level, and are you kind of contemplating increasing the duration in your portfolios?
So what we like is pretty much the 3 to 6 year point on the quality curve.
Yeah.
So largely sovereign, to some extent AAA. but 3 to 6 year on the sovereign curve or 3 to 6 year on the yield curve, because 6 to 10 then is very flat.
Sure.
So this allows us to run adequate duration in our view for the kind of rate cycle that we envisage in the future, which basically means that we are envisaging close to peak policy rates. But as of now, we don't have line of sight for a very meaningful rate cut cycle. We don't even know what the timing of such rate cuts is. So in a relatively flat yield curve, we think 3 to 6 year is the best, sweetest spot to be. So what we have been saying is, for investors with a 2+ year investment horizon, should look for funds which are 3 to 6 year centric on average portfolio thrust or focus. For shorter investment horizons, let's say 9 months or thereabouts, even the money market curve has repriced quite significantly. So you're now getting 1 year bank CDs at 760 to 770 levels, as we speak, or roughly in that zone. So for, let's say 6 to 9 month horizons, so you should have slightly longer horizons given slightly higher market volatility, but even that has repriced quite substantially. So you are at a point in time in fixed income that not only, as we observed, probably fixed income is expected inflation beating now, but by not taking too much duration or too much credit risk, you can actually build a very, very decent fixed income book with a 2 to 3 year investment horizon.
And if you look at the broad trends in the industry in terms of the flows that are coming to the mutual funds, I mean, given the kind of volatility we have seen, there has been increased interest towards your passive or target maturity funds versus active managed funds. So should one start allocating slightly more towards the active managed funds now on?
So the way I would look at this is, so when you say passive, representing target maturity funds, right? It's a great product innovation. It's a low cost product, and it helps you time an investment horizon with maturity of the product, or match, rather, not time, but match your investment horizon with maturity of the product. The one downside is that it subjects you to reinvestment risk, right? So for example, as an example, suppose you are in a 3 year target maturity and 1.5 to 2 years from now interest rates start to fall, assuming that's not the view, I'm just illustrating with an example, then that subjects you to reinvestment risk. So without getting into an active or passive debate, what I would say is that even with a substantial allocation to target maturity, one should still probably think about open-ended fixed income funds, even if, let's say, in the short-term, medium-term category, and not necessarily the very large active funds like dynamic or gilt funds, right? Or the very heavily active funds like dynamic or gilt. I mean, you may not want to go substantially there owing to the higher volatility there, but some allocation to traditional open-ended funds basically to some extent helps plug the reinvestment risk that automatically arises in an index fund. I think one of the things which probably has greater room for acceptance is this PRC framework that SEBI has introduced for mutual funds, which allows you to judge the quality bias of every product in every category relative to the rest of its peers, and in an absolute sense also, what the intended risk profile is. And that can actually be used as a very, very robust building block for building a fixed income portfolio.
And what you're suggesting is bulk of the portfolio should be towards the medium duration active managed funds. But a core or satellite portion of the portfolio, can it be looked at from allocating towards your long-term or dynamic bond funds?
Absolutely. So in some sense, not just medium, but let's say a short-term, medium-term, etc., but funds that are quality focused right now, because credit spreads are very low in the system today, right? So quality focused, short-term, medium-term, alongside index, because index is a very important ingredient in our view because of the advantages that we discussed. But the only disadvantage is the reinvestment risk issue, which is why you need the open-ended funds also. Dynamic gilt kind of products are satellite bucket allocation, because they can take higher amount of interest rate risk and therefore subject you to more volatility. So as long as you keep a constrained amount of allocation there, it will also help you ride that volatility in the future.
No. You alluded to the credit spreads being the lowest in the recent times, and you've in general stayed away from credit, and now I don't think you would kind of go down the path of taking incremental credit in your portfolios.
So look, We have products in the satellite bucket where they are positioned to take more credit risk.
Sure.
It's just at this juncture, credit spreads, like you said, are reasonably low. So beyond what is mandated from an asset allocation standpoint, at this juncture, it may not make too much sense. But at some juncture, when spreads open up in the satellite bucket, to whatever extent we find feasible, we would want to increase credit exposure in those funds.
Sure, sure. So, to summarize our conversation, what you're saying is the globe is not in as volatile shape as it was 2 years back or even say last year, and most of the risks emanating from rate hikes are kind of towards the peak, and from here on we might not see too much of shocks coming in from that side. And from an RBI perspective also, we have the policy meeting tomorrow and announcement coming in, and you don't see too much of an upside from here. And hence, from an investment perspective, one should look for short to medium duration active funds as bulk of their core portfolio, and some kind of allocation can be given to the dynamic bond fund or the long duration portfolios.
Yes, I mean, I'm not sure about most of core as short term and medium term. It could, depends on client's risk appetite or the amount of importance they assign to reinvestment risk. It could actually be bulk in index also.
Sure.
If the importance assigned to reinvestment risk is that much lower.
Sure. No, thank you, Suyash, for taking us through your insights on macros, on portfolio investment strategies, and with that we can kind of come to the end of the session. Thank you so much.
Thank you so much.